Good morning, everyone. I am Cindy Reyes, the Financial Education Manager here at EdFed, and I would like to welcome you to another EdFed Academy webinar, Understanding Your Credit. EdFed Academy, if you don't know, is our financial education platform where we offer webinars and workshops on various topics in effort to provide financial education and product solutions for our members. Before we begin our exciting workshop, I do want to kind of remind everybody that our participants have been muted just to allow to keep us on track. We will have some time for Q&A at the end of our presentation, so don't worry about that. This topic, like I said, usually I'm very excited about our topics, but with this one in specific, it's a very hot topic because credit really affects so many parts of our lives. I think in general, it's affected every workshop we've done this year. We really hope to provide you some helpful information that's going to help you understand how to build credit, how to improve it, and how to maintain credit. I do want to talk a little bit about our business partner, Experian, and how they really make the most impact. They make credit and lending easier, faster, and safer. They empower consumers to improve their financial lives overall, helping businesses verify identity and combat fraud, which is huge. They help organizations make smarter business decisions, and they enable businesses to understand and connect. I do want to reintroduce myself for those who don't know me. I am the Financial Education Manager here at EdFed, and I'm going to be your host for today. But we are super thrilled to have an expert from one of our business partners, Experian. I have Mr. Rod Griffin. He is the Senior Director of Consumer Education and Advocacy for Experian. And Rod manages the award-winning National Consumer Education and Advocacy Program in North America. He has more than 25 years of experience in the credit reporting and information services industry and is an expert on consumer issues, particularly credit reporting, credit scoring, and identity theft. A lot of things that we're going to be talking about today. And like I said, we're super excited to have him with us. And at the end of our session, we're going to go ahead and have some time for Q&A. So I'm going to go ahead and stop sharing so that Rod can share his screen and start our presentation. Thank you and welcome, Rod.
Good morning, Cindy. Thank you so much. And let me see if you can hit the right buttons here.
No worries.
Here we go. Can you see that?
Yes.
Excellent. So good morning, everybody, and thank you for joining on a Saturday morning. And it's a pleasure for me to be here and to talk to you about something that touches all of our lives, and including mine. My name is in the credit. I have my own credit report as well, just like everyone else. So understanding how it works, how credit scores work, can help you become more financially successful and improve your financial health and help you achieve your financial goals. And that's really what we want to help you do today. I will try not to talk too much and go too long, although I have a habit, and leave you 15 or 20 minutes to have a discussion at the end and answer any questions you have. But I always start with this concept. Credit's a privilege you earn. It's not a right you have. So using credit well over time, demonstrating that you can manage debts well, will result in future financial opportunities. So if you use your credit well, it's going to give you greater access to financial resources, save you money in the long term for all sorts of things that credit touches. Credit isn't just about getting credit cards or car loans or home loans today. Credit and credit reporting also plays a role in things like opening utility service accounts, leasing an apartment, getting a cell phone, all of those things that we do in our daily life that are credit-like. And so having credit and using it well is going to help you be more financially successful. And the choice is yours. I want to help you have the information you need to make the right choices around credit and how it works. That leads to this discussion. Where in the world are the credit reports from and who maintains them? Well, there are three national credit reporting companies, Experian, Equifax, and TransUnion. We collect and store information that is compiled into credit reports and used by businesses to help make risk-based decisions, to help them engage with their customers. Unfortunately, for most people, the first interaction you may have with Experian is because you've had a problem. You've maybe been a victim of identity theft. You've had an account that you believe's been misreported, a payment, something like that. You've had a declination, didn't get approved, and so reach out to Experian for assistance. But the reality is, in most transactions that occur, we're operating in the background and we help people get the credit and resources and services they need. So that's the way we want it. We want it to be something that we do that you can rely on to be able to get the financial services you need without jumping through lots of hoops, and make it as seamless as possible. We have a national automated credit reporting system. In the past, you had to build relationships with the merchants in a community. And when I say past, not that long ago, 150 years ago, 120 years ago, you went into a store and the store owner would give you credit at the store. And if you moved to a new community, you started all over again with that personal relationship. Because we have a national credit reporting system, your credit and your financial references move with you wherever you might go. And as a result, we're able to help people qualify for instant credit in the background. So when you apply online or you apply at a brick and mortar store, you can get approved right away. We make credit lower cost than almost anywhere else in the world. In fact, lower than anywhere else in the world that I'm aware of. For instance, credit card rates today in the US are kind of at an all-time high. They're about 21, 22% on average across the country. But in other parts of the world, they're 25, 26, 27% on average. So a bit less expensive. You cannot buy a home even at 6% interest in most parts of the world today. And that's because we're able to provide a credit history that helps people demonstrate they're a good risk and qualify for lower rates, because businesses suffer fewer losses as a result of default. We make credit, as I mentioned, nationwide. So you can move from where I am in Dallas to where you are in Florida and be able to carry your credit with you, open an account at EdFed, be able to qualify for credit at EdFed without losing access to those financial resources. And we make credit widespread in terms of its availability. You can use your credit for just about anything. And we wouldn't necessarily recommend that, but you can. So if you move to Miami and rent an apartment, your credit report might play a part in qualifying for that lease. You will potentially need to furnish that apartment. So you could buy a purple couch and green curtains and whatever you want. Again, not an interior decorator either, but you might want to do that and furnish the apartment. You could do that, buy the car that's parked in the driveway, all of those things using credit. And that's why it's important to make good decisions as to when and how you use your credit. Most important, your credit report should be an account management tool. You should use it as you do a billing statement each month or your bank account statement each month. Know exactly what's there, because it's going to help you better manage your credit relationships. It could help alert you to potential identity theft or fraud so you can recover more quickly. It can help you be able to walk into a lender with what we call swagger, credit swagger, and say, look, I know what's here. I know what you're going to see. I need to apply, and I know you're going to approve my application. That's where we want you to be when you use your credit. We want it to be a financial tool, not a financial barrier. So where does that credit report come from? When does it begin? And I have people with new babies, and they say, I just got had a new child, and I got their social security number. Can I get a copy of their credit report? And I always tell them, I hope not, because that would mean that your child is already a victim of identity theft, because you don't get a credit report opened like you do a social security number. For most people, your credit history comes into being when you open your first credit account. So you go to the lender, they approve your application. At the end of that first billing cycle, you're going to pay that lender. The lender will then update its records and report that account to Experian. At that point, we create the credit report for you. So you don't have a credit report generally until the end of the first billing cycle, 30 to 45 days after you open that first account. From there, you'll make those payments on time every month, we hope, and you'll apply in the future for another new account. That potential new lender is going to look at your credit report, say, hey, you managed the first account well, we'll open another one for you, and start that process over, and a new account gets added. And over time, you build a credit history. Pretty simple. idea, pretty straightforward, but you don't typically have a credit history until, for most people, you're in your late teens, early 20s in most cases. So you have the credit report. What's the role of the credit reporting company in the lending process? There are a lot of misperceptions about what we do as a credit bureau. And things like, people will tell me, well, the credit bureau denied my credit. We don't do that. We don't approve or deny your credit. The credit bureau says I have bad credit. We don't. We don't determine whether your credit is good or bad. We don't make judgments about the information. That's the role of the lender. They use your credit history to help them determine whether your credit history meets their criteria and their qualifications. We're providing information to help them make good decisions, to help connect with you, and to manage their risk of that relationship and help you gain access to it. But we're not making judgments about the information in a credit report. We act more like a library. We collect and store information in a way that a business can check out if they have a library card, kind of like the library uses the Dewey Decimal System. We have at Experian what we call a relational database. So you actually don't have a credit report sitting with Experian right now. We have a database with identifying information. We have databases with mortgages, with auto loans, with credit cards, and with other various databases. When you apply for credit and that lender requests your credit report, they provide your identifying information. We access that, and then we go to each of our databases and compile that credit report at that moment in time, and then return that credit report to the lender. That process, from the moment we get the request to the moment it's returned to the lender, takes about 12 1,000ths of a second. So it's really, really fast, but you don't have a credit report with us until you apply and that report's requested. So it represents the information in your credit report at that moment in time. Businesses can only do that and request that report if they have a library card, if they have what we call a permissible purpose under federal law. And those permissible purposes are very limited. So not just anyone can get your credit report, and not just for any reason. I'm going to ask all of you a question just to see if you're going to keep you awake this morning. And if you want to put your answer in the chat and kind of participate just to keep everybody engaged. Which of the following is not a permissible purpose for accessing a person's credit report? A, pre-approved offers of credit. B, underwriting insurance. C, test driving a new car. Or D, eligibility for a government license. And I'll give just a few seconds to see if you want to take a shot at that. See which ones you think they are. If you want to put your answers in the chat. And if not, I'll give you the answer. Give just a few more seconds. I don't see anything popping in the chat, so maybe the chat. Oh, see, somebody says C. Steve Webb says C. And Steve's the only brave soul. So, and Steve is right. Test driving a new car is not a permissible purpose under federal law. So if you went to the Ferrari dealership and said, hey, I'd like to drive that Ferrari around the block a few times, is that all right? And they said, sure, I'll ride along with you. You drove it around and said, thank you so much when you got back and walked away. They do not have a permissible purpose to check your credit report. Now, if along the way you said, how much does this Ferrari cost? You've begun a new financial discussion and expressed interest potentially in buying the car, at which point they do have then a permissible purpose. These are the permissible purposes for getting your fair credit report. The only reason someone can get one. Most of them are pretty logical and seem pretty sensible and easy to understand. Others maybe not quite so much. So opening or managing credit accounts, of course, that's would seem like something they would do when you apply. Offers of credit. So if you get a pre-approved offer of credit in the mail, they have done an automated review of our credit reporting systems. And what happens is no person actually looks at a credit report. The lender sends us, or the credit card company, whoever it might be, sends us a list of criteria that they want, a mailing list of people who match that criteria. And so we run that against our database of about 220 million people and provide a mailing list. of who meets those criteria. They then can send that pre-approved offer or pre-screened offer to you. And then when you say, I want to accept it, you've now applied, and they can check your credit report again, because now you've initiated that relationship, that application. And the pre-approved offer process can take a number of months from the time they ask us to provide the review and the mailing list to the time they actually send the offer and get it back. And so for that reason, they're able to then check your credit report again when you say, I'd like to accept it, because your situation may have changed and you may no longer meet those criteria. So they can check again on the back end. It's important to know that with pre-approved offers, that you will see a record of it in what we call the soft inquiry section of your credit report. They don't affect credit scores or lending decisions when they make those offers, so you don't have to worry about them in that regard. And it's important to understand that they kind of open up competition for you, so you may want to receive them. If you don't want pre-approved offers, you can opt out. You just call 1-888-567-8688, 1-888-5-OPT-OUT, and you can request to be removed from those mailing offers. There's also a website that you can go to. It's it's either optoutprescreen.com or prescreenoptout.com, and I always get them backwards, but you can try. You'll find one of them. So you can opt out if you choose to. Employment purposes, it's important to understand that if you're applying for a job, an employer, if they first get written permission from you, can check your credit report. It's also important to understand that when you hear that someone on the TV news or the radio, or read it in a magazine or a newspaper, if you still read newspapers, if they still exist, that says your credit score keeps you from getting a job, that is absolutely false. Employers never, ever get credit scores. I can't stress that enough. Employers do not get credit scores, and they do not get a full credit report. So any information that would impact Equal Employment Opportunity Act regulations, things like your age and those sorts of things, are removed from the credit report. Account numbers are removed from the credit report for employment purposes. And so it's a limited version of the credit report, and they never get credit scores. So credit scores don't affect employment decisions. When we see reports used for employment purposes, it's generally for jobs that involve managing a company's money in some way. You're going to be an accountant. You might be managing a cashier, those sorts of things, to see how you're doing with your own personal finances. If you're managing them well, probably do well with the company. The other reason that we see credit reports checked for employment is for application fraud prevention. If you are applying for a job, as I said, I live in Texas, down in Houston, Texas, they have chemical plants. They use credit reports to match to the applications, because they want to make sure that that person is who they say they are, because giving someone a job with dangerous chemicals could pose a threat to the public. So they do it for fraud identity and verification, identity verification purposes. So a couple of reasons we see them for the most part. Underwriting insurance. Insurance companies use credit reports not to predict that you'll have a car wreck. So that's not what insurance insurance reports are doing. And they have their own kind of credit scores, different from what lenders use. But what they're looking at is, can you make your premium payment on time, which is very much like a loan payment, same amount once a month for most people, or will you make a financial claim with the insurance company, and what's that risk for them? And so how do they manage risk? They're not predicting whether you'll wreck your car, although I hear people say that all the time. A business transaction initiated by the consumer means you've applied for credit. That would make perfect sense. A court order or federal grand jury subpoena, of course, we are going to respond to in accordance with the law. Eligibility for certain government licenses or things like security clearances, very important. They do check credit reports for those instances. So if you serve in our armed forces or have family members or friends who do, first, let me thank you for your service and them for theirs. And second, make sure they take care of their credit report, because it can affect their ability to get the clearances they need to do their jobs. And I have family and friends who serve and understand very well that if they can't do their job, people's lives can be on the line. So make sure they take care of that credit history. And disclosure to you as a consumer. You can get your own report as often as you like. That will not affect lending decisions, does not affect credit scores in any way. So do not be afraid to check your own credit report. So that leads us to this question. What is a credit report? Well, simply a record of your financial accounts and obligations, the identity that goes with them. We call it a credit file, a credit history. We collect information from thousands of sources really, and bankruptcy public records. Bankruptcies are the only public record that is actually in a credit report. They're important because they're used by lenders, of course, to help manage with approving applications for loans. They help you to get the kinds of financial tools you need for things like credit cards and home loans, but other services as well, and can affect how much you pay for them. So if you have good credit scores, it's going to help you pay less. It's going to save you money, and that's really important. It's also used now in other non-lending situations. And I mentioned employment and insurance, also apartment rental, utility service, cell phone agreements are all using credit histories now as part of them. So you can actually have those things reported to us, to help as streaming services, even to help improve your credit scores. Again, they serve as your financial references. So you want them to be like your resume if you're applying for a job. Be sure that you take care of that report. So what's in a credit report? Pretty straightforward. Starts with your identifying information. There are about 220 million people with credit reports. We need to know who you are to match it correctly. So your name, your address, your social security number, your date of birth, previous addresses, and any variations in your social security number or addresses or name that's reported to us. When you read those reports about how inaccurate credit reports are, look at the footnotes. The two most famous ones in particular will say that 85% of what they identified as errors are variations in your name, your address, and your social security number. Those are not errors. We list those on purpose. We want you to know what your lenders and others reporting to your credit report are telling us with regard to your name and your social security number. We don't have access to the Social Security Administration records to match Rod Griffin to my social security number. And so we have very sophisticated computer matching logic that helps us identify which is most likely the correct social. But if you have 10 accounts, 9 of them report one social and the 10th report something different, we're going to show that because you need to see it. It's same thing's true for addresses. Same thing's true for name variations. My dad could never decide what his name was. It was Adrian Dale Griffin, and that was on the report. But every year he'd tell me, oh, you just need to have the right name. And I'd say, what do you mean? Well, Adrian Griffin and Dale Griffin and A.D. Griffin and A. Dale Griffin were all on the report. My question was, well, have you applied for credit using those names? And he said, yes, every single time. And I said, well, then those are going to be there because your lenders are reporting. You want to have a complete and accurate record of what's being reported. The name's there that you don't recognize, it could indicate fraud. So again, we're going to list it. Account information, and I should say names and identifying information do not affect credit scores. So important to understand that too. Account information, of course, is the heart of the credit report. So every type of account you might have, whether it's an installment loan for something like a car or furniture, a credit card that's called a revolving account, a charge account that looks like a credit card, but you have to pay it every month. It will show your relationship to that account. Are you the primary account holder, an authorized user? Are you a co-signer? It will show the original loan amount or the principal loan amount for an installment loan and your credit limit for a credit card. It will also show the remaining balance for an installment loan and your current balance for your credit card. Most important, the account information will show your payment history. Are you paying that bill on time, or are your payments late? And if they're late, how late are they? Payments for a credit bureau are 30 days, 60 days, 90 days. So you have to miss a full billing cycle before we would have a late payment reported to your credit report. So if you miss a payment by 1 day, and then the next day you catch up on that payment, it will not show up in your credit report, but it could affect late fees, those sorts of things with the lender. So it's important to understand that, but you wouldn't see it on the credit report until you've missed a full 30 days. Bankruptcy public records are the only public records in a credit report. We used to have lots of public records. We used to have things like civil judgments if you were sued in court and you lost. We had tax liens, paid and unpaid, no longer part of a credit report. We used to have parking tickets. So if you got a parking ticket in a city, that could have appeared in a credit report. When I started with the company, we actually had library fines still in the credit reports. If you didn't return that library book, they might have reported that to Experian. No longer do that. The only public record you will see now is a bankruptcy public record. It's debt related. Inquiries are simply a record of who's looked at your credit report. There are two types. There are inquiries that we call hard inquiries. They're the result of your application for credit. They can be shared with lenders, and they can have a small impact on credit scores. The reason is you've applied for an account. There's no new debt showing in the report yet. And so it's an unknown debt that creates some risk. Inquiries, though, are the least important factor in credit scores. I never worry about inquiries, because if an inquiry becomes a factor in that score, it's because you already have other more serious issues. You're going to have late payments. You might have bankruptcy. You might have other issues. An inquiry is called the fifth factor in the credit reporting world, because when you get a credit score, they'll show 4 factors. If there's a fifth one, it's inquiries, because we're required to list inquiries if it even has a single point impact on the score. They are always the least important factor. The other kind of inquiry we call soft inquiries. Those do not have any effect on credit scores. And so you'll see things like pre-approved offers, getting your own report, reviews for insurance or employment that you would see on your personal report. They, in most cases, aren't shared with lenders. Some may be, depending on the nature with new developments in the reporting world, but they do not affect credit scores in any way. So 2 types of inquiries to be aware of. Usually don't see very many hard inquiries. You might see a lot of soft inquiries. And dispute instructions. You need to know, if you find something you believe is inaccurate, you need to be able to contact us and dispute that information to have it updated or corrected. And you'll find those instructions in your report. So what's not in a credit report? Well, anything that's not debt related is the easy answer. So we don't have information about criminal backgrounds, so arrest records, those sorts of things. We don't have medical information in a credit report. And everybody stops me right there and says, well, what about medical collections? And that's true. We may have medical collections. There are several things to understand about them. With medical collections, we remove any information that would indicate who provided the treatment, what condition the treatment was provided for. So that medical information, it would just say medical collection on the report the lender gets. Now, on your personal report, we do provide contact information for the medical collection company or the healthcare provider, so that you can contact them, because you might need that information. But there's no medical information specific to what the issue was. It's also important to know that medical collections are essentially held for a year before they are put on a credit report, so that if there's a billing error or an insurance dispute, that sort of thing, there's time to resolve those before they come to the report. We've also removed any medical collections from reports that are less than $500. So if there's, it has to be more than $500. If you have a paid medical collection or settled medical collection, those will also be removed from the credit report. So we removed between 70 and 80% of medical collections over the last 3 years. So it's getting less and less. Not sure they're even going to remain. There's some public policy debate around that. We don't have buying habits or transaction data. We don't know what you bought with your credit card. We just see a balance increase. Might see a car loan, so you bought a car potentially, but wouldn't know what it is. There's nothing about income or other assets. Lenders are looking at credit reports to determine your, what we call propensity to repay a debt, the likelihood to repay it, not your ability to repay. They'll use other information to determine that. And the reality is, just because a person may have $1 million in the bank, they might have a 401k, an IRA, CDs, all of those things, they may not use that money to pay their debts. And so they need to know that you have the ability to repay, but also that you will have the will or likeliness to repay using that money. So just because you're a millionaire doesn't mean you'll repay your debts on time. My wife once said, and I repeat it because it's true, there are a lot of deadbeat millionaires out there. So, that's what it's about. Credit scores are also not part of a credit report. And that's, I have to stress, credit scores are not part of a credit report. Before I jump into credit scores, I want to quickly touch on some relatively new developments in the credit reporting world that Experian provides. One of our missions is to help people empower themselves to have better financial health and better financial opportunity. And one of the things that we introduced in 2019, now almost 5 years ago, doesn't seem like it's been that long, was something we call Experian Boost. Experian Boost is a free service. It's permission based, so you give us permission to check your bank accounts that you pay your utility services, your streaming services, so things like natural gas, water, electricity, Netflix, Hulu, those sorts of streaming services, your cell phone bills. Today, some rental payments, and we're working toward including insurance payments as well. You can ask us to have those reported. And the way we do it is you give us permission to check the bank account or credit card that you make those payments through each month so that we can capture that payment. And then we add each of them to your credit report. So you can say, I have a gas bill, I have a Netflix account and a cell phone bill. I want to add those to my credit report. And we would go out, if you're the accounts they're paid from, we go out, capture those payments, and we would add 3 new accounts to your credit report. All positive information only. So not negative. The reason we do that is that those kinds of businesses have very credit-like relationships, but they don't historically report positive information to us. They would report the negative stuff. If you didn't pay them, the collection account would show up, but they didn't report the positive information. And what we found is that people who are making those kinds of payments on time, especially if they have very little credit history or have had some issues and are turning things around, indicate that they are probably a better credit risk than their traditional information shows. And so we've tried to empower people to add that information themselves, to have that positive information reported. What we see is an average increase of about 13 points. And for people with what we call thin files, fewer than 5 accounts, an increase of closer to 19 points on average. Not everyone sees an increase, but 2 out of 3 do. But it's something you might check out, Experian.com/boost. We're finding it to be a very powerful tool in helping people build credit and get started. The other thing we did just a year or so ago was introduce something called Experian Go. If you enroll in our free app and you do not have a credit report with us, we will create one for you using your identifying information and some other details you provide that just would have your credit report, your what we call header data, your identifying information, and then the rest of the report would be blank. But you could then add Experian Boost. We've seen people move from no credit report at all to scores around 630 in some instances in a matter of 15 or 20 minutes. That's not a great score, but it gets you into the system. It overcomes that barrier to access. It's so critical. And we know it's important because we have about 28 million credit invisible consumers in the country. We know that Black and Hispanic populations are adversely represented. About 26%, more than a quarter of Black and Hispanic consumers are either unscorable or credit invisible. We know that 4 million consumers turn 18 every year. And we know that 20 million consumers are somewhere between 18 and 23 and likely don't have a credit report. We also get 30,000 calls a month from people saying they want to establish a credit report directly. So we know it's important and are looking for ways to help people get into that system. I won't spend a lot of time going through this, but all you have to do is open the app and follow the instructions. Really simple to do. And if you have a report with us, you can enroll in the app. If you don't, we'll ask you to start this process. If you need to dispute information, you find something you believe is inaccurate, couple of things I want to touch on here. One, you can go to Experian.com/dispute and just follow the instructions. We'll give you a free report. Each one of them has a button next to the entry, whatever those entries are, and you just click on that, follow the instructions. You can also write or call, and that the address and phone number will be provided with a free report that you can get from Experian. You can get your report from Experian, TransUnion, and Equifax for free through annualcreditreport.com once a week now. And so that's 156 free reports a year. It used to be the law says you can get 3, one from each of the bureaus once a year. We as an industry provide 1 a week. So there's no reason not to get your report. If you dispute, the key thing here is you need to be specific. You need to tell us things like this account is not mine, or this account is fraudulent, or this account was never late, and specify that account and be specific. It's really important to help us be able to relay that information to the source so that they can check their records, which are required to do by federal law, and then respond to us. You should allow 30 to 45 days for a dispute to be processed. That's what the law says. Most of the time, disputes are completed in 8 to 10 to 14 business days, something like that, often in 2 to 3 days, because it's an automated process now. We used to mail things back and forth. We don't have to very often. The other key thing here is if you disagree with the results of a dispute, the last bullet here, you can add what we call a statement of dispute to your credit report. A statement of dispute says, I disagree, and here's why. It lets you tell your side of the story. Anytime your report will be requested, the business or organization requesting it will be notified that that statement is there, and they should look at that and give you a chance to respond. So we strongly encourage you to add a statement of dispute if you disagree with the results of a dispute. This is the thing that most people want me to talk about, I think. Well, this and then scores. So we have to lay the foundation to talk about scores because scores are built on credit reports and the information in it. So having talked about reports, the next question we get is, when does the bad stuff come off my report? And this is how long information remains. And it's really pretty simple. Open accounts in good standing remain indefinitely. I've seen accounts that have been open for 30 years that are on a credit report. Closed accounts in good standing remain for 10 years. So if you have an account, you don't need it anymore, you ask the lender to close it, you don't have any late payments, it's going to stay 10 years from the date it's closed. We keep the good stuff longer than the bad stuff. Late payments remain for 7 years from the date of the missed payment. It gets a little complicated with collection accounts. Collection accounts remain 7 years from what we call the original delinquency date of the original account. So if you have an account, it becomes late today, you never catch up, the account is charged off as a loss and sold to collections. 7 years from today, the original debt and the collection account will be deleted. So we treat the collection as a continuation of the original debt. It gets a little complicated in that if you can have more than one delinquency date, and that can change things a bit. So if you have an account, you miss a payment today, next month you catch up, the account's reported as current, and then the next month you fall behind again and never catch up, and it's sold to collections. 7 years from that first late payment, that first payment will be removed, and then a month will pass because it was current, and then the account will be deleted along with the collection account. So it's that original delinquency date, it's the date you first became late, and after which the account was never again current. That's the kind of the key there. It's a little complicated. Chapter 7 bankruptcy remains for 10 years from the filing date because you do not repay any of the debt. Chapter 13 bankruptcy remains 7 years from the filing date because you repay part of the debt. So you get it stays less time. Inquiries remain for 2 years from the date of the inquiry. However, they only really affect credit scores for generally 2 to 3 months from the date of the inquiry, because by then there's either a new account and that's the risk indicator, or there isn't a new account and so there's no new debt, so it doesn't represent risk. FICO says they ignore inquiries after 12 months entirely. So they're there for a record for 2 years by law, but really only have a short-term effect on scores. So in the interest of time, I think I'm going to just give you the answer to this poll because, again, I've talked too much. But which of the following is not a credit myth? A, when paid, the bad debt goes away. B, a person can have a 900 credit score. C, consumers must give their permission for a report to be issued. Or D, the credit bureaus are responsible for choosing who gets credit. Which one of those? If you want to put your answer in, I'll count to 10 and see what you think. There's a few D's, a B, and which is not a credit myth. A few A's, got a little bit of everything. The answer is actually B. You can have a 900 credit score. There's a lot of myth about credit scores, and I'll touch on those in just a minute. I won't hit all of these. I'll kind of hit the corners because they're the things we hear most about and the most challenging. When paid, the bad debt goes away. That's not true. For example, you have a collection account, you pay that collection account. The status of that account will be updated to show that it's paid, but it wouldn't go away right away. It's that 7-year thing that we retain them for. A divorce decree separates joint accounts. That's a really tough one. A divorce decree is an agreement between the divorcing couple and the court. It does not break the contracts you have with lenders. So you have to go to the lenders, and the lenders have to agree to change your contract. They may not do that. The mortgages, for example, very large debts, they may want 2 people securing that debt. So the divorce decree is just an agreement between you and the court, and there's a lot of confusion about that. It doesn't break those contracts. You must give permission for a report to be issued. You don't, with the exception of employment purposes. That's the only time you have to actually give written permission for your credit report to be accessed. Most of the time you do. When you read the contract and the fine print, somewhere it says, by signing this application, you're giving us permission to check your report. But lenders don't have to do that. Pre-approved offers are the common example. And there's only one credit score, and it is on every credit report. In fact, there are hundreds of different credit scores. You have 3 credit reports. You have potentially have hundreds of different credit scores. And I'll talk about why that is in just a moment. So first, what is a credit score? Well, a credit score is simply a tool that's used to analyze the information in your credit report instead of a manual score sheet. I actually talked to a little tiny credit union in West Texas that actually used a pencil and paper until about 2 years ago. Surprised me. I didn't know they still did that, but it's an automated tool. It's a very valuable risk management tool. It's very objective. It takes personal bias out of the process. It looks at the data and says this person pays their bills on time. They meet the criteria we have. They're a good credit risk. There are many different models with many different scales for many different sources for the different types of lending and different types of lenders. The reason there are different kinds of scores is that, for example, there are credit unions. Their customers tend to have certain characteristics. And so they have scores that help them predict the lending risk associated with their kinds of customers. National banks customers tend to have different kinds of payment habits and different kinds of financial agreements. And so their scores are different to reflect their customer behaviors. So that's one reason you see different scores, different types of lenders. The other is because there are different types of lending. For example, if you're getting a credit card, they want to know you'll pay your credit card bill on time. So they have scores designed specifically to help them identify that risk. If you're buying a car, they're going to look at whether you'll pay your car loan on time. So there are credit scores specific to auto lending. In fact, the FICO auto lending scores go to 900. So you could have, if you have that quote perfect score, you could have a 900 FICO score. Generally here 350 to 850, that's the common scale, but there are industry specific scores with different scales. And so there are different scores for different types of lending. Mortgage lenders use different scores. Insurance companies use different scores, but they all use the information from your credit report to do the calculation. So they're all looking at the same information, just a little bit differently. So that's why it's so important to take care of that credit report. Our role in that process is to what we call apply the model in some cases, so we can route your credit report. If we're asked for a report, we provide a service of routing it through a FICO score or a Vantage score, for example, and then the score and the report go out together in parallel to the lender, and the lender says, I want the identifying information credit report on my screen, and then the scores, and then the rest of the report. So it looks like your credit score is part of the report when in fact it's not. It's a separate process. FICO gets paid for their score. We get paid for the credit report. And so that's one way it happens. Another way scores happen is that we send the report to the lender, and the lender then applies their own scores. So we don't know anything about the score that's happening there, aren't involved at all. And in mortgage lending, we'll send a report to a third-party mortgage reporting company. They get reports from the other bureaus, they get other application information, other data, and then they do the scoring and send all of that to the mortgage lender. So we wouldn't be involved at all either. So the credit report is still the key factor, the key component of credit scores. Knowing that there are lots of scores, hundreds of them, in fact, how do you know how to make them better? Because I always tell people in a conversation like this, I've known Cindy a little bit. We've talked. I think her score's probably about a 285. And people go, oh my word, that's terrible. In fact, that's a very good score. There was a score years ago that was called the National Risk Model, and the scale was 1,300 to 0. The lower the score, the better. So a 285 is like an 840 on a FICO score. So you can't compare the numbers without context. If you're talking to a lender, of course they're important and they know what that scale is. So how do you make the numbers better? Well, what people don't know is that every time a credit score is calculated, a series of what we call risk factors are generated. Those risk factors tell you exactly what you need to work on from your credit report to make that score better. Unlike the numbers that can vary tremendously, the risk factors tend to be very, very consistent. So if you focus on the risk factors, tie them back to your credit report and use them to set a plan and focus on those issues, you can make all of your credit scores better. So focus on those risk factors, use your credit report. Don't worry as much about the number. The number, of course, is important when you're sitting with a lender, but otherwise, it's just a nice place to know. You can get a number, know pretty much where you stand in terms of risk, but the risk factors are what are going to empower you to take action to make those scores better. Focus on those risk factors. Numbers important, but not as important as your credit report and those the risk factors that go with them. So when you get a score, make sure you get the risk factors. One more poll: which is not a credit score risk factor? A, credit utilization; B, the balance of your checking account; C, your payment history; or D, how long you've used credit. Really quickly, we'll have give you just a couple minutes. And already people are getting it right. So the balance of your checking account, we don't have financial asset information. So we don't know what's in your checking account. So it's not affecting credit scores. And that's not what they're worried about. They're worried about your ability to repay and how you're managing the debts you owe. This is from Vantage Score 4.0. I call it their donut. They took the middle out of the pie. But I like to share this because what it really reiterates and reinforces is that no matter what score you're looking at, the things that most affect the scores are the same. Payment history is always going to be the most important. Are you paying your bills on time, or are they late? If they're late, how late are they? In this case, it's about 41% of the score, give or take. It can be a little more or less depending on your credit history. Utilization rate, your balance to limit ratio on your credit cards, is the second most important factor. With Vantage Score in their chart, they break it out into total utilization, add up all of your cards and all of your limits, and then individual accounts. So high balances on one card can affect your credit scores. That's true for other scores as well. But utilization rate, balance to limit ratio. So add up your balances and your limits, divide, you get a balance to limit ratio, is going to be the second most important factor by far. In this case, you're talking 26%, almost 30%. You'll see the same kind of number for FICO. Utilization rate is somewhere in the 30% range. You're talking about 60 to 70% of a credit score will be your payment history and your utilization rate. So if you pay your bills on time, keep your credit card balances low, your scores will get better and you'll have good scores. Everything else builds on that. How long you use credit, your depth of credit, what's your mix of credit, will depend on making those other payments on time and keeping those balances low. If you're managing those two things, your recent credit, the number of inquiries you have, any payments recently, have you paid off accounts recently, have you closed accounts recently, will be positive. You're not going to see late payments recently. That's going to hurt your score. So builds on that. It's about 11%. And then available credit, your overall capacity they build in to get to that 100% here. Similar in other scoring systems. Pay those bills on time, keep your balances low. There's no quick fix. You can't fix the number. You have to change the information in your credit report, and you can do that. No matter how serious things feel or seem or are at the moment, you can restore your credit history. It's not like the history in the school books. You can rewrite your credit report, and you can take action to do that. Use the tools that are available and seek help. EdFed will, I'm sure, want to help you because they want to do business with you and they want to help educate you. That's why we're here this morning, is to help people have the information they need to make better decisions, to help be more successful. Address those risk factors. You can rebuild your credit history over time and improve those scores. Just a few resources. We provide a free monitoring service, of course. You get a free FICO score and a free report every 30 days. We provide monitoring of the web and the dark web as well, and provide alerts. So you can find tools and resources there. You can get a free report under the law from each of the national credit reporting companies. The law says once every 12 months. We provide one once a week. So you can get, again, 156 free reports a year if you want to. I don't know you need it that often, but you can. And we have a number of resources as well. You can join us on X, formerly known as Twitter. You can learn more every Wednesday, 2 o'clock Central, 3 Eastern, ex.pn/credit chat. We talk about all sorts of personal finance topics with lots of experts and influencers. And if you go to Experian.com, you can find this presentation. You can find other education resources and tools that can help you understand and improve your credit history and have better success in the future. And with that, I'll stop talking and stop sharing and answer any questions. A little bit long.
Yes, thank you so much, Rod. We do have a few questions to cover. The first one that I saw is there an app that you recommend that shows the correct score to what the bank will see when you're planning on purchasing a home? Is there an app that you recommend?
So you will almost never get a score that will exactly match what the lender sees, regardless of the type of lender. And the reason goes to what we were just talking about. There are lots and lots of different scores. The lenders determine which scores they want to use. When you get a credit score from Experian, we provide a FICO 8 model in our base level, the premium service. And I have my one perk is a free subscription to our premium service. We provide another 6 or 8 different FICO models, including a mortgage model. Model is another term we use for a credit score formula. So credit scores. But because lenders get scores that are specific to their needs, they have their own custom scores. They may get a score, say a FICO 8 score, but they get a TransUnion. It's calculated using a TransUnion report instead of an Experian report. They may get you get your report today, and then in 3 weeks or even a week, you go apply. Well, information may have changed, so the score could be different. Even it's exactly the same score. So you don't try to match the number to what your lender gets. What you should know is if you get a score from Experian, a FICO 8 score, it will show if it's a good score, you can almost certainly walk into the lender and they'll have a good score too. So it gives you a basis. They're real scores. It's just that there are so many different factors that weigh in that you probably won't see the number match, but that shouldn't be the goal. They're good scores. It's just timing plays a big part. I talked to a lady who was telling me her score didn't match and she needed to, it should. And I finally asked her, well, when did you get the score? And she said 6 years ago. And I went, well, I know that's not going to work. So everything's changed since then, a lot. So don't try to match the numbers. They'll probably be close. If it's a FICO score that you're getting, say from Experian and EdFed, those numbers probably won't be exactly the same, but they'll be within a reasonable number of points. It's depending on the score. So don't try to match the number. Instead, look at what the risk level is indicated by with the score you get. And if that risk level says you're an excellent score or excellent risk, walk into the lender and be pretty darn confident that they're going to tell you the same thing.
Great. I also have a few more. So the next one I have is a website or a phone number that maybe we can provide to opt out of pre-approved offers. Does that exist? What can we share?
So pre-approved offer, you can opt out by calling 1-888-5-OPT-OUT, 1-888-567-8688. And let me look because I always, like I said, I get backwards. There is on the other computer. If you go to optoutprescreen.com, that is the website that you can use to then opt out of getting pre-approved offers from Experian. You should know too, if when you opt out, you won't see a decrease in those offers right away. As I said, it takes, in some cases, 6 months. I've seen an instance where it was a year between the time we processed the mailing list to the time they sent it. So if there are things in the process already that have gone through the screening, you'll continue to get those. So what I usually say is you give it about 6 months and you'll probably see then a significant decrease.
Okay.
Also understand one other thing with pre-approved offers, it's not going to help the election offer information you're getting. The politicians opted themselves out of opting out and doing pre-screens, and there are other exceptions. So, charitable things and those sorts of things. So you may still see some that aren't part of that process.
Okay, I have a few more. Now does a purchase such as a car or house immediately drop your credit score, or does it depend on keeping up with the payments?
Yeah, so a little both. When you apply for new credit, there'll be an inquiry, so you might see a small decrease right away. Typically, that's 5 or 10 points, and generally that's not enough to be very meaningful. When you open a new account, there's now a new account with no payment history. That indicates risk, so your score will tend to slip a bit. once you start making those payments on time, your score is going to come back up. And so it's a little bit of both. Scores tend to, when you open new accounts, dip and then recover, and they tend to recover pretty quickly from there as you make payments. If you miss a payment, that's going to wreck your score right away.
Okay, I have my credit score dropped by 19 points after I paid off my student loan. Why would that
Mm-hmm.
happen?
Yeah, so you've 19 points is very small. Keep that in mind. And it happens when you pay off a loan because that loan is then closed. That creates a big shift in the credit history. And so scoring systems look at that and go, don't know what happened exactly. Score's going to slide a little. And then within a month or two, what you usually see is the scores begin to come back up again as things stabilize and it becomes clear what happened was good. It wasn't a bad thing. And then it will recover. I paid off my house and my score dropped like 60 points. And, it took about 4 or 5 months and it came back up. It's just anytime you make a big change, scores first reaction tends to be to dip a bit and then bounce back up.
Thank you. I have another question from a member. Can you tell us about LexisNexis and their role in the credit world?
Yeah, so LexisNexis is another information services company. They don't do credit in the same way. They don't really do credit reporting, but they have other kinds of data. For example, those public records that came off the credit report, tax liens, as soon as our credit reporting industry removed them, LexisNexis started collecting them. And so a business, if they get your credit report, just because tax liens no longer affect credit scores and aren't part of credit report doesn't mean they won't see them. They may get a LexisNexis report. So there are different kinds of data. There are different sorts of data providers out there. There are debit bureaus that do checking account management. So if you're bouncing checks, a debit bureau might have that information, a similar kind of thing. So we just do credit.
I have a question about Experian identity theft account. Somebody has an Experian identity theft account and they were told that their phone number was found on the dark web. Should I be concerned?
I smiled because I got the same notice. My name is on the dark web too, and Experian told me that. And the reality is, yes, you should be concerned. The sad reality is there's not much you can do except monitor your credit history, monitor the information that's out there. And that's the benefit of a service like Experian is if something happens with it, if something gets to the credit report, they're going to tell you right away, and then you can respond. So it's about monitoring. For most people, the reality is our identities have been compromised, almost all of us. And so it's probably out there somewhere in the fortunate thing, I wouldn't call it good news, but maybe the slightly fortunate thing is that for most of us, we don't have whatever it is they're interested in using our names for. And so far, my name hasn't popped up anywhere else. So I think that's true for most people, but I still watch very closely.
Okay. We have another question. Does business credit affect personal credit or vice versa?
Yeah. Generally, no. But if you are a small business owner and you're using your personal credit to underwrite business credit purchases, it could in some way. So if you're using your personal credit to get a loan for equipment for your business, that because you use your personal credit to underwrite it, if you don't pay those bills, that loan could be on your personal report that could affect it. That's why we encourage people to start to build a business credit report. And Experian has a business credit reporting business. We call business information services. If you have a business credit report it's important to separate your business debt from your personal credit as soon as you can, because that will prevent it from having an effect on your personal credit. If something goes wrong with the business, you don't want it to drag down your personal credit and vice versa.
I have a question about your Experian Boost. Somebody wants to know if can Experian Boost work without giving access to your banking account? I was using the Boost feature. However, I needed to provide my password to my account and it kept showing as an unknown access to my banking information.
No, it can't. And that's the only way we can get that information, because it's not reported to the business. So, and we don't, I say we, Experian actually doesn't directly access your accounts. We work with a third party that does that and then transfers it to us. So we're not the ones going directly into the account, if that, that helps. But no, we have to have the ability to capture that payment from your bank. Not all institutions are um, allowing access at this point. More and more are all the time. And so we're working with them to do that.
Okay, we have a few more. One of
Okay.
them asks, does paying off your balance at the end of the billing statement affect your score negatively? I have a nice score, but would like to increase it.
Yeah. No. So, there are different strategies people talk about to try to improve a score. If you pay off the balance uh, when you get the billing statement, it will be reported as paid in full, or zero balance on your credit report. Well, it will be reported as paid in your credit report. The balance that will show in your report, and this is where it might make a difference, is the balance in your credit report is generally the balance shown on your billing statement. So if you pay, people say, well, you should pay like twice during the month. Well, what that might do if you pay early is result in a lower balance being reported. And so it's not the payment, it's the utilization rate that's affected. And that's what's really important. It's that utilization rate thing. So if you can keep your balances as low as possible, that's going to help. The only way to have a zero balance reported is to pay your a credit card, for example, pay it in full and then not use it for an entire month, so that a zero balance is reported. And then that's when you would see a zero balance. If you use it and there's a balance at the end of the cycle, it's going to show that balance.
Okay, so we have a few more questions that are coming in. I have that why are we talking so much about pre-approved offers? What are their purpose? What's their role, I guess, in the market? Like, what is that? How does that
Yeah.
affect?
So pre-approved offers actually expand the market. They create competition for consumers. They give you the ability to, find resources outside of where you might be living. Example I used, I lived in a tiny little town in Western Kansas, and the vet, one of the richest men in town, obviously, had only banked with the little local bank, and they didn't report his payment information to the credit bureaus. He wanted to take a trip overseas, so he wanted a credit card that didn't have overseas transactions and that kind of thing, fees and things. So he applied at a major national bank and got declined because he had no credit history. And so what pre-approved offers will do is, and he used a pre-approved offer to qualify for an account with a national bank because he had no access otherwise. And this was like pre-internet too. So pre-approved offers actually cause lenders to compete for your business. That gives you an advantage. And the most powerful word in credit is like two letters. It's no. If you can say no, get pre-approved offers, shred them. If you don't want them, find one that gives you better rates or gives you better incentives or whatever. That gives you an opportunity. And that's really the point. Businesses are trying to compete for you to be a customer, and that helps them do that.
Okay, and let's see. We have a few more. Let's see. I have never had a credit card, but my FICO score is showing up as 643. Is that a bad score?
Um, it's not good. So prime scores are typically 700 and above. And, the best scores, what we call super prime, are 750 and higher. Near prime is generally 680 ish. Um, so it needs some help. Having a credit card, just one, you don't need 5 or 10, can help improve your credit scores a bit more quickly. The reason is, with a credit card, you're told, here's how much you can spend, you get to decide. And so there's free will, and you get to decide how much you're going to charge each month, how much you're going to pay. So you pay it in full, or you pay the minimum due, something in between. Are you maxing it out, or are you just using, making a small purchase? That sort of free will can help improve scores a bit. Scores weigh them a bit more heavily. So not a bad idea to have a credit card, one, maybe two. You don't have to have a huge limit. It's about, making a small purchase, pay it in full, show that consistently, and that will help. And then time. The more gray hair you get, the longer that history is, the more information to make a decision, your scores will tend to creep up too.
Okay, so we have two more, one of which says, given you're paying off your home loan example that you stated, if you have no other accounts after that, does your score recover like you mentioned, or does it stay the same or continue going down after
Yeah.
it initially dipped?
So if you pay off an account, eventually that's going to be removed from the credit report. If you don't have any other credit history, your credit report will essentially disappear. It will that account, when it's removed, if there's nothing else being reported, leaves nothing in the credit history. So it's a good idea to keep, if you can have an account like we talked about, maybe have a security account, maybe have a small, a checking, or pardon me, a small credit card account that you make purchases on, and keep that credit history active. Scores don't only look at if there's an account present, they also require there to be activity. So when you open a new credit card account, it will appear in your credit report. Scores won't include it in the calculation until you have 3 to 6 months of activity. So you have to have, make a small purchase, pay it in full each month, so you have activity in that account, or it could be on your credit report and not helping your credit scores at all. And so it's important to have activity too.
Okay, and then our last and final question, because we have gone over, how long should I wait to apply for an unsecured credit card after I opened a secured credit card to build my credit?
Yeah. I always say that 6 months is a starting point. Gives time for there to be a history there. Maybe have a free monitoring service where you can see what's happening with your scores as they go up, and then talk to EdFed and see if they can convert that secured account to a traditional account, or maybe open a new account for you, and see what they can offer, because you need a little bit of history. So 6 months to a year, and then generally that's a good starting point.
All right. Thank you so much, everybody, for our Q&A session. Thank you, Rod, for answering all those questions. I am going to go ahead and share my screen one more time so everybody can see our handle here, edfed.org. They can follow us at all our social media platforms at edfedcu is our handle. This webinar is going to be posted on our YouTube page. We do have an upcoming webinar next month, as we always do, as part of our EdFed Academy platform. It's going to be on home buying. We really would love to have all of you join us. I do want to thank you again, Rod, for being such an amazing presenter. This was such great information. I know I am a credit nerd. I love everything about credit, but it really does affect so many different parts of our lives. And so I think this was super informative, and I am looking forward to seeing all of you on the next webinar. Thank you so much.
Thank you.